BloombergQuint. We've just got a set of GDP data for Q3. Growth is being pegged at 5.4%, slightly lower than what was being anticipated. These are also the second advance estimates for the full year numbers, and that's now pegged at 8.9% growth in terms of full year GDP. Joining us to help us understand some of these numbers, DK Joshi, Chief Economist at CRISIL, Madan Sabnavis, Chief Economist at Bank of Baroda. Thank you both so much for taking the time to speak to us. Mr. Joshi, let me start with you. Help us analyze both the Q3 headline numbers and the downward revision that we've seen in the second advance estimates. The latter is a little bit because of revisions to previous year's numbers, I understand.
Yeah. So I think as far as the third quarter is concerned, it's a tad lower than what was expected. We were expecting around 6%, and probably the reason is more from the supply side, because some of the supply bottlenecks were becoming more visible, and I think that reflected more in the manufacturing sector, which did quite poorly. So I think that's responsible for the decline in third quarter. Now the annual estimate means that the fourth quarter is supposed to be reasonably good. I mean, otherwise you will not get this 8.9%. If you look at now, one of the major highlights of this today's number is that in the first advance estimates, the private consumption was trailing the pre-pandemic level. Now all the components of demand are above the pre-pandemic level, even though mildly. I think where the stress is now being estimated as more than previously computed is the contact-based services, which is trade, hotels, etc., which are now contracting by 10.9%. So clearly, I think this means that the contact-based services have been hit harder. But now let me also point out that the first and second advance estimates are anyway subject to change when more information available. This time they'll be subject to even more change, because the first risk when the first advance estimates came out in early January was your Omicron, which is still not factored in this. And now I think then the Omicron has definitely turned out to be milder than what people were expecting, but it has been replaced very quickly by a very potent risk, which is Ukraine-Russia crisis, and this is bound to have an impact on us, because the oil prices impact the economy in multiple ways. I mean, and GDP is only one of the ways. I mean, inflation, current account. So it has a very significant impact on the economy. So how the oil plays out and what impact it has, even in the last 1 month, is going to have an impact on your next GDP estimate. So I will look at the 31st May data for somewhat reliable estimate of GDP, and I think so I think that's what I make out of it as a first cut.
Okay, you're basically saying that we shouldn't even bother discussing these numbers, but I'll request you to bear with us for another 10 odd minutes. Madan, sir, what do you make of the headline numbers and what stood out for you?
So actually, I think that the number of 8.9% is close to the 8.8%, which was implied when we had the revised numbers for 2021 coming in. Now, in these particular numbers, I think if I look at the annual basis, there are certain surprise factors, both the annual numbers as well as the Q3 numbers. So one is that we have seen that overall consumption as a proportion of GDP in current terms is actually coming down in this year. Now, this is contrary to what we were expecting, or what we thought would have taken place based on the corporate results, where they actually were very gung-ho about the pent-up demand really picking up in the third quarter, the festival season, the post-harvest season, with lots of companies actually putting it up in their investor presentations that they have done very well. So quite clearly in Q3, we have seen it's been a very minuscule growth, I think 0.2% for manufacturing. And if you combine it with the fact that corporate profitability has actually been very robust in the third quarter, so it's a bit difficult to reconcile, because you're using the value addition, which is profits plus salaries and wages. Salaries have supposedly recovered, and profits have been very good. So if I combine these factors, it's a bit hard to believe that manufacturing actually grew by just 0.2%. It's of course true that the SME sector has not quite recovered, and that is something which could be driving the overall numbers down. The other thing is in terms of share of gross fixed capital in GDP, I think that actually shows there's been an increase. Now, if I look at the monetary side or the funding side of capital formation, we really don't see that kind of buoyancy in the debt market or in bank credit, especially to the non-retail side. So this actually begs a question about whether this gross fixed capital formation rate actually means anything significant or not. Is investment really taking place?
Yeah.
Because we know one thing, that the central government is probably keeping up with its commitment of 5.54 lakh crores. We're not quite sure about the states, because if you look at the state data, their capex has been trailing. Of course, it's another case to say in the next 3 months they'll do it. But to my mind, I think they may be struggling to achieve the fiscal deficit numbers and cut corners. And the private sector doesn't show any definite positive signs of investment. So I think these two have been the puzzling factors. Otherwise, I would say it's more or less on expected lines. And I think the Omicron, as what the Dharm Kirti has been saying, has not been that potent, and maybe there's some impact of Ukraine. So they could neutralize one another. Now, the implicit number we get for the Q4 growth would be around 4.8%, which means a slowdown from the 5.4%. Maybe the 4.8 could be slightly higher, is what our estimate is right now, that it could be slightly higher because the Omicron has not been that potent. And also, I think that what Dharm Kirti was saying, I would tend to believe that whatever happens in the markets, that is a forex market or your price market, that's inflation, will probably affect us with a lag in terms of GDP. There's going to be more volatility in terms of all the markets, interest rates, currencies, inflation, everything's going to be high. But ours is a domestic-oriented economy, so I would tend to believe that agriculture, for example, will be on its normal path, depending on the monsoons. Demand will revive as jobs are created. So I think the GDP growth story could probably be decoupled from the Ukraine story as of now, the way in which I look at it.
I'm just going to focus on a few numbers, and now I'm looking at Q3, Mr. Joshi, because those are the real numbers that we have. So if one looks at the private consumption number, that 7% growth is reasonably strong. Is that a festive seasonal impact? On the flip side, like you had mentioned, investment growth or gross fixed capital formation growth has come off. That suggests that perhaps some amount of slowdown from the state spending, or that the private capex side is also not as robust as people were suggesting.
Well, I think the private capex cycle is not that strong. I mean, that I would agree. And as far as the government capex is concerned, I think you will see the maximum impact in the fourth quarter, not in the third quarter. Because even for the central government, by the month of December, I think, or November, only about a little over 50% of the capex budget was utilized. And I think in December, it went up to 70%. So they were it's always backloaded. I mean, the states are lagging behind clearly. So I think the capex from the government side is weak, and private is yet to fully, only to come back. I mean, only segments like your steel, cement, etc. I think these are the ones which are going in for investments, and others are, I think, are supported by the PLI, which is only beginning to show an impact. Now, as far as I think the private consumption is concerned, I think some of the bounce back third quarter would have seen is because the services became active. I mean, so that would have helped the private consumption somewhat. But in the next quarter, I think that's got reversed, because the annual numbers tell me that the overall contact-based services are now contracting much more than what that was estimated earlier. So what it means is that I think the fourth quarter probably will see a bigger hit to contact-based services, and possibly to consumption as well. I mean, so we'll need to watch out for that data. So there is a lot of noise also in the information that is in the quarterly data, so to say. So I would generally, I think, look at it more directionally than in terms of the exact quantum of impact at this juncture.
No, that's fair enough. In fact, directionally then, Madan sir, I mean, so if one talks about goods demand and services demand, are there enough indications that pent-up demand for goods at least is now going to flatten out? Whatever was there happened in the earlier quarters, and Q3, Q4, etc. will probably be slightly flatter, and then it depends on how quickly the services side recovers.
No, in fact, Ira, I would be a bit more sanguine about services doing well in the fourth quarter. Because there's already this pent-up demand of saying that I want to make good of what I couldn't do in say January as well as in December. So in terms of travel, for example, or generally going out and dining out, I think these are the major things, recreation, these kind of things. I think it's already been a case of pent-up demand, something which is going to manifest itself in this quarter. So I would tend to believe that in this fourth quarter, these services would probably tend to do better than what we had expected earlier, essentially because of this pent-up demand factor. In terms of goods, definitely, yes, there would be a certain level of saturation, except for the fact that by the time we come towards March, there could be some kind of a revival in terms of demand, especially for a thing like automobiles, provided the automobile sector is able to meet this demand. That's also a time when normally people would tend to purchase goods. Because again, we have this festival coming, Holi coming. I'm not quite sure how the auto demand will manifest, but normally these are the occasions when people tend to buy the vehicles. So we need to keep a close monitor about how retail sales of automobiles behave during this particular month of March.
There are, of course, concerns that, again, you'll see supply disruptions because of chip shortages, etc., worsen because of what's happening in Russia and Ukraine. DK sir, just coming back to you. So on the sectoral side, manufacturing was certainly disappointing, as was construction. Any specific reasons to attribute there? Again, like you said, there's just so much noise in this data because of the year-on-year numbers, etc. Not clear what the trend here is underlying.
Well, I think one is the automobile sector hasn't done that well. I mean, that's a significant part of the manufacturing. But overall, I think the supply shortages were being felt, I think, during that period. And my worry is that the Ukraine crisis, which is I think which is now playing out and even intensifying, I think that's going to create shortage for or at least disruption, if not shortage, for things like palladium, titanium. I think where Russia is a key player, I think globally a key exporter, and even fertilizers. I mean, from an agriculture perspective, particularly phosphatic fertilizers. So I think this is another round of disruption that we are going to see, and this could to some extent reflect in the manufacturing sector as well. So I would keep my fingers crossed and keep my eyes peeled for incoming data to assess, I think, how it is going to impact. Right now, I think it's kind of a wild card. I mean, I would say, because the information that we get from Ukraine-Russia conflict, I think that is also incomplete in a way, and we have not fully, and the sanctions, etc., are ongoing. So clearly, I think unless things stabilize a bit and we know what is the base case scenario going to look like, it will be difficult to assess, I think, what the impact is.
But Madan sir, are you so far holding on? I mean, based on the numbers that you've seen so far, and if you're just looking directionally, for instance, is there any reason to change what we were expecting for the next fiscal year, both vis-a-vis what the government has suggested in its budget or what the RBI is suggesting? Those still seem reasonable to you?
No, in terms of the real economic indicator like GDP, I think when we are talking, RBI spoke of 7.8%, we are looking at 7.75 to 8%. I think that number does not really change. But if I'm looking at prices, if I'm looking at inflation, I'm looking at currencies, I think definitely there is a lot of work for the NPC to do. And the kind of stance which they took in the February policy cannot probably be replicated. And I think at some point of time, we need to really look at inflation quite seriously, because I think inflation is a major concern. And to say that we are not going to tackle inflation because it's transient may not be an argument which will hold in the current situation. And definitely there is a case for revisiting this whole concept of whether you should be increasing the repo rate. I think it should be done faster. They have spoken of an accommodative policy for the entire year. And at that point of time, we felt that maybe in the second half, there could be a repo rate hike. But probably that could be considered even earlier, depending upon how the petroleum prices behave by the time we come to April. We should also remember that once the elections are over, they'll get over in very soon, there will be a tendency in the normal course for the prices to go up, which is going to feed into inflation quite significantly.
DK sir, last question to you then. I mean, again, in the midst of all of this data, so much of it distorted by base effect and, changes in the environment almost on a quarter-on-quarter basis. What's the big picture for the economy as we see it right now? Earlier we were mapping it to pre-pandemic levels. Now we're above that. But I guess the question now is, where are we vis-a-vis pre-pandemic trends, or how else are you understanding what's happening in the economy?
Well, I think there are two factors which will, for 22-23, will be very critical to watch. I think nobody is talking about COVID-19 right now. It's not that it has disappeared. I think there's always possibility of new variants. So we need to be watchful of that. And I think the second risk is what is happening in the Ukraine area. And I think if oil prices remain elevated, I think we will have to knock down our GDP forecast. I mean, by elevated means above 100, because our base calculation is based on 80 to 85. So I think that trend in oil is going to be very critical. Now, if COVID remains low, and I think we are in an endemic stage, then I think we still will hold on to our growth forecast of 7.8%, which incidentally, I think we did it before the RBI, so it's not RBI's number. It's our independent forecast. So I think that needs to. So from a growth perspective, this is important. From an inflation perspective, I would be looking very closely at how the monsoons play out. Agriculture has been exceptionally good this year. We produced more food grains than we targeted. The problem is in edible oils. I mean, where the production is lacking and is below the target, and also global prices of edible oils are firming up. I mean, as we speak. So clearly, that pressure on food inflation will be there. On the non-food side is the major worry. I mean, because the input costs rising, and actually companies haven't passed on these to end consumer. And I think they are, if input costs rise further, then I think they will have to pass it on to the end consumer to protect their margins. So I do see, I think, a pressure on inflation emerging, and depending on how the Fed tunes its or retunes its monetary policy in wake of the new geopolitical risk that has emerged, I think we probably will have to change our monetary policy stance maybe sooner than we currently expect. Now, if we get lucky, oil actually comes down, this crisis is blows out quickly, then I think we are in a scenario where I think what RBI is saying could play out, because then the commodity, all those things which are hot right now will come, their inflation will come down quickly. But that's not the base case for us. I mean, the base case right now seems to be a scenario where the inflation pressures will remain elevated. So you have a budget which is focused on infrastructure, which plays out with a lag. You have monetary policy which is continuing to be growth supportive. So for private consumption to improve, it's very, very critical in this scenario that Omicron just remains low right now. If it again resurfaces, then with the mix of all this is going to pull the economy down.
Lots of uncertainties. I think that's the key takeaway.
Yeah.
Thank you both for this quick conversation on the GDP numbers. Thanks for watching BloombergQuint. We kept it short because, as DK Joshi said, a lot has changed between the numbers that came out and what we're facing right now. Thanks for watching.
Thank you.